All right, look, we might kick off since I'm going through a lot of the boring stuff anyway before we get to our main speakers. So thanks for those that have joined so far. Welcome to our first Market Pulse commercial webinar for 2026 to share our data-driven insights. You would have noticed a bit of a name change, so all the great information around the insights just with a new name. So I think a lot of people saw it come through with a bit of a name change and weren't 100% sure. So thanks for joining our session today, guys. Look, we do have a lot of new people joining today that I saw as well. So hopefully you'll all find some great value out of that. And hopefully it'll provide you with a bit of information as well to be able to help you work smarter as an individual, but also hopefully make some better business decisions. We do have a couple of speakers today. We've got Brad, who's the GM of Commercial Services at Equifax, to run through the latest insights. And that will be followed by our special guest today, which is Tim Beresford, which I'll try not to axe the introduction to that. So Tim is the Chief Executive and Inspector General in Bankruptcy. So the Chief Executive at AFSA, the Australian Financial Security Authority, having joined that agency in mid-2022. So AFSA's role is to be able to support a strong credit system in Australia and is visible, modern and a contemporary regulator. The agency administers and regulates the personal insolvency and personal property securities systems and manages criminal assets. Tim is a board member as well of the St George Community Housing and the immediate past chair of the Benevolent Society, TBS. So Australia's oldest non-Indigenous not-for-profit. Previously, Tim has held roles as the acting chief executive of the Australian Trade and Investment Commission, Deputy Vice Chancellor of the Macquarie University and First Assistant Secretary of the Social Policy Division in Department of the Prime Minister and Cabinet. So appreciate that. Sorry guys, I'm trying to read small letters on my screen at the same time, so hopefully I didn't ruin that too much, Tim. Look, we'll get straight into it. I can still see some people joining. There's a lot of great information to be able to get through. So Brad, I'll chuck it straight over you to kick us off.
Thank you, Adam, and great to be back unveiling the Q4 of 2025 insights. Welcome back for those that are regulars in this series, and if you're new, a great opportunity for us here at Equifax and the commercial team to unveil, some of the insights that we're seeing across the market. And so, look forward to your questions towards the back of the webinar. I guess maybe to set the scene, it's a good news story. We've seen, the growth in business confidence since mid last year. We've also seen business conditions continuing to improve strongly, notably in Q4, and that's on the back of strong sales across the quarter. But the other thing that's been encouraging to see is the significant increase and the acceleration of private CapEx. The businesses being confident enough to really invest in tomorrow, and so that's been underpinning the overall rise in the credit demand, which was up for the quarter, but notably for business loans as businesses were looking to fund their growth. So we'll deep dive on credit demand shortly, but at the 30,000 foot view, another key call out there is what we're seeing across the small to medium-sized businesses. So really encouraging to see them start to really show some increase in demand. There's about 4.5% up in demand from SMBs for the Q4, which was really good to see. Also, good to see the credit quality holding. So it was about 2 points up. Good to see that stable. But they're still on a recovery path. So we haven't yet got back to some of the historical levels on the basis of index demand from the last 4 years. They're still about 9-10% below where they were on that index level. But speaking of SMBs and notably looking at Victoria, really encouraging as we look across the states and territories to see Victoria finally signalling a recovery. This has been a long time coming, as for those that have been a part of this series for some time. Great to see the sectoral growth. We'll touch on that, as well as the falling insolvencies there in Victoria, really turning a corner. So we'll talk about some of the various sectors there supporting that growth. Also seeing a bit of a pullback in some states, notably Western Australia and Queensland. Queensland, a bit of a pullback, so we'll talk about that when we look at across the various states and territories. Another good call out, while company insolvencies are slow, albeit at peak levels, business-related personal insolvencies have been climbing. So we'll have a look at that. There was certainly a spike in the month of October last year, highest on record around company insolvencies. But underpinning what's happening across Q4, we did see a significant increase in new tax debt disclosures. So they were about 36% up versus 5% fewer tax debt disclosure removals. So we'll also have a look at that. A number of sectors that we typically try and canvass as a part of this series. We look at hospitality as one. Great to see the rebound, both in demand and also its credit quality. So we'll look at those. Seeing that play out as well around the improvements across their trade payment performance, as well as their declining insolvencies in hospitality. We'll also look at construction, really a tale of two stories. Strong growth there with larger businesses powering ahead, a bit of a pullback across SMBs, the smaller businesses, so we'll look at that. Professional services, a lot of businesses in this sector. Great to see demand rising, but we're also seeing some continued reconfigurations of the mix in this space. It's great to see growing investment, notably in technology, higher skills outsourcing, and the AI capabilities. So we'll look at professional services, and importantly also retail. While not specifically called out on the headline slides, great to see strong growth, notably by the larger retailers as they seek credit to fuel the growth, and across New South Wales in particular. But again, we'll also be calling out some things we're seeing there around the tax debt disclosures. They're significantly up in retail, and also the spike in company insolvencies. So even if you didn't hear too much more as a part of my presentation, that's really the headlines, and that's what we're really going to unpack as we power through the next couple of slides. Next slide. If we just jump to the next slide. Thanks. Excellent. So credit demand overall rose year over year. Great to see that. That's on the basis of the fact that we've seen some interest rate stability across H2 of last year. And we also spoke about the rising levels of both business confidence, but also business conditions. And that's really underpinned what we've seen there with the growth and demand for business loans, 4.1% up for the quarter. New South Wales, so you'll see on the chart on the left, experienced strong growth. Queensland in particular, if you just go back a slide, thanks. Queensland and Western Australia, a bit of a slowdown there in their credit demand. Both, I think, were about 5% up in Q3. So you'll see that those have been slowing in Q4. And while business loans led the charge, you'll see their asset finance, a bit of an uptick. That was on the back end of that private capital investment activity that we spoke about, and notably across the rise in equipment, plant and machinery purchases. Next slide. Application quality, looking at the business scores, notably for business loans, 3-year peaks. So it's a great outcome. You'll see that there in the chart on the left, the middle green line. Looking at the chart on the right, it's really looking at the distribution of credit scores and how they've compared to about 3 years ago. And the good news is we've seen a bit of a reduction in the proportion of those that are at that higher risk end. So you'll see that there notably in that 500 to 600 credit score band. On the flip side, good news, that's 700 through to 900, those scoring bands, we've seen an increase in the distribution of those going through across all 3 different categories shown there. So great to see that play out. That's really consistent with the longer term trend we're seeing there as ongoing shifts towards the higher credit score bands and an improvement in the risk profile of credit seekers. Looking again at that sort of where we're seeing most of the activity, it's really in that sort of central piece, the 700 to 800 credit score band, most active across the market in seeking credit, and notably for business loans. If we go to the next slide. Looking at small to medium-sized businesses, good news story here. Demand is up, rising business confidence, and especially seen across New South Wales, SA and Western Australia. But I did want to call out Victoria. So if you look down there, it might only be a smaller percent. This is really a pivotal moment for Victoria. It's marking a turnaround in that credit demand. This is the first time we've seen growth after 4 consecutive quarters in the red. So a great news story, not just for a number of states, but importantly for Victoria. Looking at the charts on the right, again, credit quality of SMBs relatively resilient. They're still on a recovery trajectory in terms of demand, and importantly, demand's not sort of yet back to the same level that it was about 4 years ago. It's still on a recovery path to meet the same growth that its larger businesses have seen, and notably over the last 5 to 6 quarters, we've seen effectively larger businesses having that growth and demand. We haven't seen that same sort of trend play out across SMBs just yet, but they are on that road to recovery. And importantly, their credit appetite has been rising more recently. So again, encouraging to see that. Next slide, thank you. Well, this is an interesting tale. We've got here the company insolvencies have slowed, and that story continues to play out early this year. We saw a 13% reduction in January for that month, year on year. But on the flip side, they're still elevated, but we've also seen non-company insolvencies, business-related personal insolvencies rising. The other key call out here, of course, is what we're seeing with the tax debt disclosures. We've seen a 36% increase in new debt disclosures over the last quarter relative to the prior year. Looking at the insolvency numbers in particular, and you can see this from the chart on the top right, the month of October reported the highest number of insolvencies on record, a huge call out. But what was encouraging is to see that over the quarter, holistically, relatively flat compared to last year. A few call outs across the various sectors in insolvencies. Firstly, hospitality continues to represent the highest proportion of credit active businesses that have been going into insolvency. The good news here with hospitality, of course, is it's a bit of a reduction in where they were in quarter three. So they've dropped back from about 4.5% and now showing about 4.1%. So at least on the right trajectory. Construction, of course, continues to represent the highest overall proportion. It's just shy of 0.25% of all insolvencies from the construction sector. Looking at the chart on the left, across the states and territories, Queensland saw the highest growth there in terms of the total number, 9%. Up. I want to call out that reduction in insolvencies from the state of the sectors. Next slide comes up. I'll start to give some private capital expenditure is really powering some of the growth, but also the increased construction activity. The number of dwellings that have commenced, they're trending up, as well as the number of dwellings under construction. So great to see that, really supporting that overall demand. Importantly, recognise though that labour constraints and elevated costs are still continuing to plague the smaller to medium-sized businesses. And you'll see that play out there on the numbers there on the left of the slide in terms of the differential between the large business demand and the SMBs. So large construction businesses certainly on the rebound, SMBs still in that sort of more defensive balance sheet management stage, but credit appetite for smaller businesses has shown some increase across asset finance or capital finance, which is good, despite the slowdown and the pullback across business loans and trade credit. Looking across the states and territories, the chart on the left, borrowers in New South Wales and Queensland, both trending up. But again, I do want to recognise Victoria. First time in 3 quarters, we've seen that trend up for the construction sector. So really encouraging. Just go to the next slide, thanks. Insolvency rates still stubbornly high on the back of that construction activity that we were talking about. It's good to see the op cash flows continue to power ahead. That's enabling businesses to be able to settle their dues more quickly. You'll see there on the chart on the right, last 18 months, we've certainly come down some way since the peak of the days beyond terms, about 18 months ago, 2 years ago. I guess it's still 70% longer to pay than the market average. But again, it's trending in the right direction, which is really encouraging. It's also encouraging to see that the insolvencies have sort of stabilised at that peak level. I will call out, though, that again, business-related personal insolvencies for construction were 12.3% up in December for the month on month. What are we seeing in terms of tax debt disclosures? It's about 31% up in new tax debt disclosures. So again, in this sector, continuing to see a lot of aged tax debt. In terms of the actual volume count of businesses in construction, the overall number of credit active businesses is relatively stable. It was about 1% up. We're seeing a decrease in the number of new company formations. That's about 3% down for 2025, while exits were up about 8%. But overall, a relatively stable number of credit active businesses in the sector. So that's a wrap for construction. Moving on to hospitality. This is really a case of the garden hose trickle versus the hydroelectric dam. When we look at the level of credit demand across large and small, you'll see that on the numbers on the left of the screen. Larger groups really leveraging their size and scale, getting that capital and funding to support activity. Smaller operators really subdued, rising inflationary pressures, particularly late Q4. Looking at the credit quality, that's the charts there on the bottom right. you'll see that the credit quality and average scores for the sector, they've actually reduced slightly from where we're reporting in Q3. But the good news is that for small to medium-sized businesses continuing to show slightly high levels of resilience to their larger counterparts. Looking at the states and territories on the left, we've got Victorian businesses showing a significant improvement in demand. For Q3, that was about a -8% contraction, where here we're seeing a 6% growth. So a big change there for the hospitality sector. Really good to see. Next slide. So we spoke about rising op costs continue to remain a concern. We are seeing the chart on the right that continued improvement in their trade payment performance. So a good call out too with insolvencies. We're also seeing those fall. We mentioned earlier they've dropped back from about 4.5% of credit active businesses to 4.1% in Q4. They're about 9% down for the quarter on last year. So great to see those numbers coming back from where they were 18 months ago. A couple of call outs though around tax debt disclosures. There was about 26% increase in new disclosures in this sector. In terms of total number of credit active businesses in hospitality, a little bit more than construction. They're about 1.4% up in terms of the total number of credit active hospitality businesses. We saw the closure rates increase by around 10% and the number of new companies decreasing by 15% year on year, but overall about 1.4% up for credit active hospitality businesses. As interest rates sort of eased in the second half, we did see an improvement in some of the cash flow of these businesses, and we did see that improve in terms of their trade payment performance. That's the chart on the right. So that's a wrap for hospitality. If we jump across to retail, we did see for that second half of the year last year that sort of rate stability together with the rising population real wage growth really did help the sector, notably the larger retailers. But the op costs did see a slight impact to the credit quality of the sector, noticeable deterioration for those seeking asset finance. And importantly, looking again at the chart there on the bottom right, for those businesses, the smaller businesses relying on trade credit also saw a deterioration in their credit scores. Looking at the chart on the left, across the various states and territories, New South Wales, there's strong growth in credit demand, but I will call out again Victoria marks that 2% growth, first time in 4 quarters where we've seen that positive growth. I think in Q3 it was about -5%. Great to see Victoria coming back. Next slide, thanks. Now, this is the flip side of that story, of course, is what we're seeing in the insolvency rates. So a significant increase in the inflationary pressures late Q4. We also saw that translate to a significant spike in retail insolvencies in December. I think that was about 3 times up for the month of December year on year. All-time high. You'll see that there play out for the quarter overall, 64% up. Business-related personal insolvencies, I think they're about 13.5% up for the month of December, month on month. But that spike in December was certainly a concern. Behind that, we do know that there's been a notable increase in tax debt disclosures across retail businesses. They're about 40% up for new tax debt disclosures across retail businesses. Despite the rise in insolvencies, the overall number of credit active businesses in retail, about 1.2% up overall. New market entrants were about 4% up for 2025. The number of exits were about 7% up, but overall 1.2% up overall in terms of the number of credit active businesses. The chart on the right, looking at the trade payment performance, it's broadly mirroring the market more holistically, but the sector does continue to show that it's settling credit dues faster than the broader market. So that's a quick wrap on retail as we go across to professional services. Business confidence, as well as the business conditions, really supporting the growth and demand for the sector. We saw that play out in terms of the sales and profitability across this segment, as well as the increased private capital and investment that's being made across the infrastructure, notably digital infrastructure, and importantly outsourcing for that high skilled space, the growth in outsourcing for that segment, as well as the technology advisory. Looking at the charts on the left, you'll see there across the states and territories, net increase in the credit volume really is a story of the growth we're seeing there across New South Wales and Western Australia. By contrast, Queensland there, you see that pullback. It was a contraction of 2% for this sector. And I believe that for Q3, it was around a 7% growth. So we are seeing that pullback with the inflation in Queensland certainly being noticed. If we just go to the next slide, thanks. So insolvency is slowing. That's good, but they do remain at elevated levels. The trade payment performance on the chart on the right is showing a deterioration with that elongation of trade payment days. Looking at the number of businesses overall, remained relatively stable, but exit rates have increased. So if we look at the makeup of the businesses behind the sector, they have certainly seen a significant increase over the last couple of years. That's more recently moderated. The number of new entrants, in particular, has seen a moderation, and we've seen effectively the number of new formations in this industry fall by 45% year on year, with an 8% rise in business exits. But as I said, relatively stable overall in terms of the number of credit active businesses. We did see, however, and a key call out, a 43% increase in new tax debt disclosures across professional services businesses. Pivoting back to the chart on the right, looking at the days beyond terms, we certainly have seen this sector have a more favourable, trade payment profile to the broader market. Q4 has seen that sort of that gap erode, with that position sort of really closed the gap between the sector and the market more broadly, with an elongation of the days beyond terms for the sector. So we've covered a lot of ground. Overall, really encouraging to see the way in which business confidence, conditions, the private business investment is really fueling growth. There's obviously some state and territory and sectoral nuances there that we've discussed, but hopefully that's been really interesting and provided some new insights. And on that note, I'll hand back to Adam.
Thanks, Brad. Guys, just very quickly as well, you will notice that there is a Q&A box down the bottom for anybody that's got a question for Brad or a question for Tim for that matter. Please ask your questions in that box and we will get to as many as we can at the end of Tim's session. As a reminder as well, you will have a feedback form at the end of the survey. So if there's any feedback from you to be able to improve the session, if you want any further information, or if you need a call from your account manager, you can include that on the feedback survey back. Outside of that, I'll pass it through to yourself, Tim. Thanks.
Thanks very much, Adam, and thanks very much, Brad, and thanks for the opportunity. I'll just start by acknowledging the traditional custodians of the land on which we're on today. I'm speaking to you from Sydney, and I'd like to just acknowledge the Gadigal people of the Eora Nation and pay my respects to their elders past and present, and all the lands on which we're on today. Look, thank you for the opportunity to speak to you about the work we are doing at AFSA to ensure a strong credit system for the Australian community. Equifax, and obviously Equifax's clients, many of you are on the call today, you all play a very important role in the credit system. All your combined work supports the free flow of credit and contributes to a dynamic economy. Today, I wanted to touch on what we're seeing in the personal insolvency space and the structural shifts that are occurring in Australia's credit system. I also would like to just touch on regulation as a productivity lever and some of the work we're doing, in particular the PPSR, or the Personal Property Security Register, which many of you would use on a regular basis to support both business and productivity growth. As Adam and Brad have already mentioned, very happy to take questions at the end. Thank you for the first slide. The first slide I wanted to turn to was basically personal insolvency trends over the last 50 years. As you can see from that slide, insolvencies, which is the black line, slowly but gradually increased from 1974 to a peak of around 37,000 around 2009-2010. That's the very top of the black line, which is just after the global financial crisis. Since the global financial crisis, or just after 2009-10, they've flattened but fallen, and most significantly they've fallen over the last 9 years, and you can see the point of inflection. It is the Hayne Royal Commission of 2007, the first and probably the most significant driver. The Royal Commission, for those that can remember, the Royal Commission was a wake-up call to the finance industry to change the way it engaged with customers. And the finance industry has heeded that call. Now creditors are much more likely to work with debtors than when they're experiencing difficulty, seek solutions, offer hardship provisions, and look to reach workable compromises. A second rationale for that dramatic fall since the Hayne Royal Commission has been a change in debtor behaviour, and that was particularly amplified during COVID, which is that shaded piece, COVID-19 economic period and response. People who are now in financial difficulty are far more likely to raise issues with their creditors. So what we're seeing is both more proactive lines of communication between debtors and creditors looking for solutions. If you could go back just one more thing, back, if that's okay. Thank you. But the final point to note in this rapid decline since the Hayne Royal Commission is unemployment. The bottom of the chart, you can eyeball it. You'll see the light blue line of the unemployment rate. 10 years ago, unemployment typically had a 5 or a 6 in front of it. But more recently, as many of you would know, it's had a 3 or a 4 in front of it, with the latest number being 4.1. So, no question, we've seen a significant reset of personal insolvency since the Hayne Royal Commission. But as is pointed out, it started to rise and there has been some modest headwinds. Clearly, there's been geopolitical tensions that have certainly created uncertainty and volatility. And as the previous discussion highlighted from Brad, we have certainly actually come out from a weaker or more softer economic performance to a much more benign credit system and a more robust growth in recent years. One of the things we're seeing in terms of driving some of that recent uplift is financial resilience in the very lowest quartile of society is really declining. In fact, 1 in 5 debtors have an asset to liability ratio of below 10%. For every $1 of liabilities, they only have 10 cents of assets, and they have no buffers to protect them from any headwinds or financial shocks. We're also seeing, as a result of these headwinds, personal insolvency volumes start to rise. The black line is starting to rise as we have a more stabilising credit conditions. And I'll unpack a little bit more of that as we move forward. But nonetheless, if you look at the 50-year view, personal insolvencies are significantly below historic averages. In fact, you have to cast your eye all the way back to the basically 1989 to actually have similar personal insolvency levels. And Australia was a lot smaller economy in 1989. Let me now turn to some of the key insights washing through the personal insolvency system. So if you could just turn to the next slide, please. Thank you. The first one I'd just like to acknowledge is the significant contraction in the unsecured credit market. Large creditors and creditors more generally make commercial decisions to reduce their unsecured exposure. As you can see from the slide, in 2008, personal credit, which is a proxy for unsecured credit, it's around 80% unsecured, was around 14% of GDP. Now, if you look at the blue line, it's sitting at 6%. And you all understand totally why that is the case. Now, instead of taking out a personal loan to buy a second-hand car, people will turn to secured credit. They'll use their redraw facility, they'll use their cost of capital. That has enabled and has further created product innovation in the unsecured market, with new players entering the market. Now you see buy now, pay later being very prominent in the credit system. A decade ago, in the personal insolvency system, buy now, pay later were about 2% of new debtors. Now they're up to half. In fact, for debtors who are under 29, it's 66%. So buy now, pay later, with its lower transactional volumes, are a significant volume effect, but the value is still relatively small. Other innovations that have come into the market are payday loans and cryptocurrency. These things have added to a higher risk component coming into the contracted personal credit system. And in addition to that, we have seen some operators walk into this market which have a lower social license to operate. And this poses a risk for vulnerable debtors, particularly the debtors we see at AFSA. if you turn to the next slide, please. The second slide I'd like to show in personal insolvencies is not only have you seen a broader contraction of personal credit, but you're also starting to see that the personal insolvency system is actually not necessarily representative of the broader economy. What we see in personal insolvency is we see a disproportionate number of renters. As you can see from the slide there, in the personal insolvency system, renters make up almost 90% of personal insolvencies compared to the economy-wide number of renters sitting at 31%. And as you can see, in the personal insolvency system, there's only 5.6% who hold a mortgage, as opposed to in the broader economy around a third, and then a third are homeowners. In the personal insolvency system, it's next to nothing. So what does that mean? Well, firstly, you've got people inside the personal insolvency system that are very vulnerable to rent increases. And they generally have little debt. Almost 50% of people inside the personal insolvency system only have $50,000 worth of debt. When you compare the average to the Australian debt household, will have 300,000, or 6 times what's sitting in the personal insolvency system. So if you think about that for a moment, $50,000 in the personal insolvency system, a debtor has on average. That's really just a couple of credit cards, maybe a personal loan, a handful of buy now, pay laters, and probably a handful of bills from suppliers. In other words, personal insolvencies are largely secured to renters with unsecured debts who have very low savings or next to no asset base. And these debtors are less able to secure themselves from external shocks, be they cost of living pressures, rent rises, or indeed geopolitical uncertainty. The third observation I'd like to share, and it does tie to what a little bit of what Brad shared a little bit early on the next slide, if you could, is the link between corporate and personal insolvency. It's probably worth just unpacking corporate and personal insolvency. And Brad talked about personal business insolvencies. So corporate insolvencies are basically proprietary limited companies. In the personal insolvency space, not only is personal insolvency mum and dad, it is also sole traders, businesses who are sole traders. It is also businesses who are in a partnership, or it's also businesses where there's a company guarantee. So when you think of personal insolvency, it's personal in the legal word, not personal in the traditional word. So we do actually have unincorporated businesses inside our personal insolvency numbers. But coming to the comparison between corporate solvencies or incorporated insolvencies and personal insolvencies, which is mum and dad and unincorporated solvencies, traditionally, there's been a very tight link between the two. Often it's been said that the link is really corporate insolvencies rise and 9 months later, personal insolvencies rise. But that is not as clear cut as you can see in this chart. And personal insolvencies have fallen dramatically as outlined from the Hayne Royal Commission. And since the COVID moratoriums are over, they have only gently risen, whilst, as Brad has already articulated, corporate insolvencies or corporate insolvencies have risen quite dramatically. My final reflection, if we could turn to the next slide, is the final insight in the personal insolvency space, and that's about the composition. Personal insolvencies, as discussed, do actually also refer to business-related insolvencies, sole traders and partnerships, as I just shared. And as you can see from this slide, whilst the number of them is smaller but rising to around 30% of overall insolvencies. If you just eyeball the 24-25 number, you can see that personal insolvencies as a total was 12,250, of which around 30% were business related. That's the light blue chart. But the value equation, that's where the value is. Of all the liabilities in terms of the personal insolvency system is concerned, which is around 20 billion, 15 billion of that are actually business-related insolvencies. And that's a really important part of the puzzle. Obviously, as you think about it, construction is significant. This was actually in Brad's presentation, but also hospitality as well also finds itself into that equation. So look, I just wanted to share those four insights about the personal insolvency system. So how are we addressing some of the issues that are sitting in the system? Well, really, those four insights really give us a sense of the dynamics unfolding in our ecosystem and how we as the regulator need to adapt to that. And one of the things I always take the opportunity is in sharing these insights and sharing them with you today, it's ultimately for all of us to actually have a conversation around how we further think about collaboration to improve regulation. So when I get on these calls, I always ask the question, the system, I always make this reflection and ask the question, the system works best when all of us work together. It works best when we all actually are collective stewards. So I really just wanted to pause for a moment and just reflect on one conversation. And that is, if you see something in our system, in our personal insolvency system, we'd really like to hear from you. Whether it's about things you see around vulnerability, whether you see things around the efficiency of the system and how we could improve the system, or indeed where you see actual general misuse. I need your ears and eyes. If you see something, please say something. You can speak to me or you can reach out on the website and or our online tip-off form. As we say, it's in all our interests to ensure the system works best, and it works best when all of us have stewardship of the system. If we all swim between the flags, it sustains a strong system, it builds confidence, and we can assure ourselves of a lighter touch approach to regulation. I wanted to turn a little bit in the final part of this presentation around insolvency as a productivity enabler. You will recall the Treasurer held an economic roundtable in August, and the government really put regulation at one of the central planks of the productivity agenda. The Treasurer described it as regulating with a growth mindset, and we are absolutely focused on that. As you all know, to have a dynamic economy, you need a seamless and efficient entry system for business to enter the system. You need to create the conditions to allow natural and opportunity for expansion. And you actually also need a very efficient and effective economic mechanism for exit so that the capital can be renewed and people can make further choices. Risk-taking, as you all know, is encouraged because failure, when it occurs, is actually resolved efficiently and effective. When we have an exit system that is slow or complex, that resources get stuck in, confidence falls and dynamism declines. So for me, insolvency is actually a key part of growth and productivity. If you will, a modern insolvency system not only is a safety net, but it actually drives, enables productivity, supports liquidity, drives investment, and encourages entrepreneurial activity. And this is borne by international evidence. The World Bank has done a lot of work about economies with efficient insolvency systems actually have consistently higher levels of entrepreneurialism and actually have an extremely dynamic small business sector. So what are we looking to do to drive that growth mindset? Next slide, please. We focus on being a proportionate, purposeful, and outcomes-focused regulator. We actually have a very clear regulatory action statement of the 4 areas of harm that we see the system is dealing with, that there is definite system misuse, and what we're doing about each one of those, ensuring it's proportionate, purposeful, and outcomes-based. The first one is around manipulating personal insolvency proposals and creditor meetings. You may have seen the recent case by the failed publican John Agimus, whose business collapsed with debts of around 1.8 billion. It is actually the largest bankruptcy since Allen Bond. And his personal insolvency agreement, or PIA as they're sometimes referred, was only going to offer creditors around 0.15 cents in the dollar. A typical personal insolvency agreement, PIA, offers creditors around 8 cents in the dollar, or 50 times what Mr. Adjamas put on the table. Even unsecured creditors that choose to go through an average bankruptcy can expect 2 to 3 cents in the dollars. So we raised concerns about the fairness of the PIA and worked back with creditors, and ultimately the federal court placed Mr. Adjamas into bankruptcy. The second harm I just wanted to touch on is unauthorised access to trust funds for personal gain. Again, I'll share the case of a federal court action against a former registered trustee, a gentleman by the name of Mr. Paul Leroy, alleging the misappropriation of more than $4 million across 5 estates. That case is currently before the courts, and we allege that Mr. Paul Leroy actively sought the trust funds for his personal gain. The third harm is around insolvency advice and debt agreements. And a good example of that was where a pre-insolvency advisor called Mr. John Volton was sentenced to 3 years imprisonment off the back of an AFSA AFP investigation, where we saw that he had an elaborate scam targeting financially vulnerable business owners. And the final one, which is probably of a lot of interest to people today, given a number of you would use the PPSR, is about not removing registrations from the PPSR. They're sometimes in the industry referred to expired registrations. Sometimes I hear the word dead registrations. Other times I hear outdated registrations. But we're always looking for people to take that next step when actually there's no longer need to have the registration because the collateral has moved on or the debt has been repaid. Then we encourage people to take the next step and remove the registration. It goes to certainty, and it goes to a better, more effective PPSR, and it goes to actually enabling commerce to get on with the job of moving credit and moving goods around the system. If I can turn to the PPSR slide, which is the next slide. As many of you know, the PPSR is our national online database for searching and registering interests. There's a number of interests that are registered, and many of you would know this: cars, boats, tools, company assets, intellectual property. It's a critical part of the system. When you actually work out what's on the database, it's around about $450 billion of potential value, around 16% of GDP. As many of you know, it's used to check assets, often cars, but not just cars. It includes intellectual property. And for businesses, it's a real vital risk management tool where they can register security interest to ensure they're being paid, or they can retrieve goods if a debtor becomes insolvent. As you can see from the numbers on the page, there were over 13 million searches, there were over 2 million registrations. The Equifax and the EDX platform is a significant user. It's around 4.5 million registrations, or 35% of the search volumes, and around 20% of registrations. You're all in a very unique position to give insights about the PPSR and how people influence and use it to ensure we sustain that integrity of the PPSR. We particularly appreciate the work of many of you who are credit specialists to educate customers on the benefits of registering assets, particularly small businesses who are often busy and lack time to be working not only in the business but on the business. As you know, and as you can see, we are seeing personal insolvencies in the business scent rise, as Brad mentioned a bit earlier, and the PPSR provides a really valuable risk management tool. As you all know, just to do a search is $2, and that gives people peace of mind. So to maintain the integrity and quality of the PPSR, it must be accurate and it must reflect the genuine outstanding security interest. What we're seeing is, in some cases, businesses and consumers tell us that secured parties sometimes are slow to move registrations, even though under the obligation of the legislation, they're required in a timely manner. What we've started is a real proactive education program to really encourage people to remove those outdated, those inactive registrations to prevent consumers or businesses from accessing credit or delay business transactions. This year, we've got a very, very proactive education and outreach program going on, and we have enjoyed really strong cooperation. To give you one example, recently in a conversation with a rather large motor financier, they proactively identified and discharged over 40,000 outdated registrations. More recently, a major bank found in one of its subsidiaries that indeed it too had a number of outdated registrations, and that was in the order of about $25,000. So that's a real major piece of work we're looking to do. We're also looking to raise the awareness around registering intangible assets like trademarks, copyrights, and intellectual property. Intellectual property or intangible assets is only a relatively small portion of the PPSR, but is growing, and as AI and technology take hold, it will only become more significant. So we're communicating with the small business community, both directly and through their own natural business processes, to how they can look to protect intangible assets as much as tangible assets like cars, trucks, or cranes. So look, in conclusion, just wanted to reflect back that we see the Australian personal insolvency and credit systems constantly evolving, the 4 insights I shared earlier. Our job is ultimately to maintain trust of these systems as they evolve, so all people, everybody can use it with confidence. And we are mindful our role as a regulator is to facilitate economic and productive growth and ensure the rules protect system integrity and honest participants can just get on with the job. We're looking to be proportionate as a regulator, focus on those 4 harms I touched on. And again, I offer the invitation, we're all collective stewards. If you see some poor behaviour, if you see something that's not quite right, we'd love to hear from you. Because if we all get that right, we have the benefit of a strong credit system, and that provides economic opportunity, growth and productivity for all. Thanks very much, and I look forward to questions from Brad, Adam and colleagues.
Hey, thanks very much, Brad, and thanks very much, Tim, as well. Really appreciate you coming on today. I get the privilege of seeing a lot of the Equifax insights, but it's really good to see some insights outside of what we do internally here as well. Guys, we do have a few questions. We'll start getting, I can see some more coming through as well. I'll start off with a few of the simple ones. A few people have asked about the deck. We'll make sure that the people on the call obviously get a copy of the deck. Brad, I might start with a quick question to you. Are there any insights that you can share around the transport and logistics sector?
Yeah, thanks, Adam. Transport, postal warehousing, logistics. I think that's a sector that has seen a bit of an increase in terms of the number of credit active businesses. It's just over 3% up. So it's seeing more of an increase in credit active businesses than a number of other sectors. We are seeing credit demand for that segment remain relatively stable. I think as you look across those 3 different categories that we speak to, it was about 4% up in asset finance, but overall, transport, postal, warehousing, I think it was relatively stable. We have seen a bit of an increase in company insolvencies. So they were about 13% up in Q4 on last year, but we are also seeing, and it might have been in one of the earlier slides, we spoke about the insolvency waterfall. The number of credit active businesses that have gone into insolvency is about, now 1.9%, just shy of 2%. That's an increase actually than where we were last time. We haven't seen the same number of new tax debt disclosures in that segment as what we've seen across other segments. It was about 12% up. But overall, we did see in that space a higher proportion of new disclosures to those that have been removed. So anyway, look, that's a bit of a snapshot. Generally speaking, good to see, a greater number and the increase in credit active businesses and credit demand relatively stable.
Great, thanks, Brad. Tim, I might jump to you for a second. Are you able to elaborate on the most significant shifts that you are seeing in the lending landscape and how these are likely to influence the future of PPSR?
Yeah, look, building on some of the observations Brad shared a little earlier, What we see is a relatively, if you look at non-performing loans, it's relatively benign at the moment, and that just echoes a lot of what Brad reflected on. And so you've actually got a relatively benign non-performing loan book across Australia. Building on what Brad said, you've actually got credit growth that's really actually starting to take off across all sectors. Obviously, business, and as Brad's articulated, the differentiation between small business and large business, and it's a relatively positive story. Yes, we need to be always mindful of shocks, of things that can impact the system. There's no question we need to be. One of the things that we'll certainly come up against is just broader economic growth. It's around a couple of percent. Obviously, if we could just push that a little higher, that would be great. But there's some significant supply constraints to actually push economic growth much above 2.1, 2.2%. But the credit growth is actually quite strong. I was just looking at the CBA result the other day, and look, CBA is not the answer, but it is 30 to 40% of the economy. It does actually have a significant book, and if you look at all the lines in that, it's actually a pretty positive story across all business lines. Now, they aren't the only bank, and I openly acknowledge they are only 30%, but they're a pretty decent chunk of the economy, and they give a pretty decent read of what they're seeing. So it's more robust and positive than maybe some commentators like to suggest.
That's great. Thanks, Tim. Brad, I might throw back to you. What do you think is behind the differences in the construction industry between the larger businesses versus these smaller operators that we're seeing?
Thanks, Adam. So differences between large and small in construction.
Yeah.
I think it's principally a reflection of the underlying drivers of demand. I think with construction, we're seeing larger infrastructure projects. We're seeing the establishment of data centers. We're seeing certainly a notable uptick in multi-unit dwellings, and that's typically by companies with larger balance sheets. They're leaning into growth. I think in the smaller space, it's highly fragmented. It's fiercely competitive. We're not seeing necessarily at the moment the same uptick in new single dwelling versus multis, but I think it also, Tim picked up on this a moment ago, it's a very tight labour market. We're continuing to have elevated costs in that sector, so that'll weigh a little bit on the growth. But overall, a positive story. I think the most positive story at the moment in construction is the fact that I think we've finally hit the peak of the company insolvencies. They've certainly been on everyone's, across media, mainstream media, and everyone's minds. When is that going to slow? So that's been really encouraging to see that sort of now start to flatten out.
Could I jump in there, Adam, just to build on Brad's
Absolutely.
point? Why possibly, so I could hear people reflecting with corporate, as in incorporated companies, just moderating, but personal as in unincorporated companies rising. I think what you find is, and you've got it in your numbers, the tax office have absolutely shifted their posture. And so what's happening here, just to bring it to the real micro, which many of you and your listeners and your viewers would hear, is somebody 5 years ago probably closed their business. It was probably a hospitality business, just allow me the liberty of this example. And they went off and got themselves a job. Back to Brad's point, there's tight labour markets and they could find a job. But now 3-4 years on, they want to start another business up because they've got that entrepreneurial flair. They want to get back out there, and maybe it's a hospitality business again, maybe. And so what they do is they go to the bank for a loan, and the bank asks for their last 5 tax returns. Now, they may have thought they closed the business, switched the lights off, but they didn't actually close the business. There was still some outstanding debts. It could have been a GST debt. It could have been a super guarantee debt. It could have been a pay-away debt. So before they can get the bank's loan, the bank needs the last 5 tax returns. That signals to the tax office that, hang on, you haven't paid things. And what you're seeing is that systems start to play forward in the personal insolvency space. It's slow, but it's actually now starting to limber up, which is why we are seeing in the personal insolvency space at the business end, the sole practitioner, the partnership, that increase as people actually are asked by the tax office, rightly, because the tax is actually collectible. It's not theirs to pay that tax. So it's a real micro factor, Adam, but it's a real micro factor, which is a significant micro factor in what we're seeing in the numbers.
No, that's great. Thank you for that insight. And obviously, between the both of you, feel free to jump in with any of those insights, regardless of who the question's for. And another question going through, I realise we're running out of time, so we'll try to get through as many as we can. For larger businesses, specifically talking about the mining sector here, how are we placed on China's dependency and any news from Trump to be careful of?
There you go. I think Tim wants to take that one first.
So let me as a humble look, there is no question that there is a repivoting here. If you looked at BHP's latest result, I think you'll find that actually their non-iron ore divisions actually outplayed their iron ore division. That is a first. But if you actually kind of just step back from it a moment, India is looking to grow. It needs steel. It needs materials. It needs energy. And at the moment in India, 50% of people are still living in rural societies, doing agricultural work. They are a long way up to go on what's called the S curve of growth, a very long way to go. So, large mining organisations like Rio, like BHP, Fortescue, and many, many others have a terrific opportunity to get the balance right as the globe actually adjusts. And yes, China is going up that S curve of growth. There's no question it is a long way up that S curve of growth. And with that provides a golden opportunity for some of those miners over the medium term to rebalance where they actually make significant relationships and export. So I see it as very, very optimistically, because I actually think there is a degree of optimism. I don't want to come across as completely half glass full. We need to be realistic in this multipolar world that we now live in. But there is actually significant opportunities. I've talked about South Asia, India in particular, but it's not just South Asia and India. It is actually Southeast Asia and other parts of the world as well. So it's a China and conversation, Adam. It's not just China, it's China and.
And just to add to that, Adam, and to build on Tim's comments, we did see for mining a 5% increase in business loan demand across miners. And that's encouraging because it was despite the fact that the private CapEx numbers, and I think they're being updated today and released today, which will be good to see, but the private CapEx numbers had reported that it was relatively subdued on the last quarter's readout. So it was encouraging to see a 5% uptick in quarter four's demand.
That's great. Thanks, Tim and Brad. Look, there are a couple more questions, guys. To be honest, we're not going to... I just saw a big drop-off of people getting to their 2 o'clock meeting. I appreciate everyone's questions. There's a few questions that have come through, like, for example, Graham, I can see one there about the fraud focus group. I'll get to those offline. So we'll get a few people and a team together to be able to respond to anyone's questions where we didn't get any answers to. Really appreciate all your time. Please keep an eye out for that survey. Would love to love your feedback. Love to get more ideas about how we can improve this for you and what you'd like to see to help you guys make better business decisions. Really appreciate your time, and thanks very much.
Thanks very much, Adam. Thanks, Brad.
Thanks, guys.